10 direct investments or portfolio companies at present, and many more through Outsourced Fund Managers. Among Ekuinas' portfolio companies include F&B like Tony Roma's, Manhattan Fish Market, New York Steak Shack, and also retails with sport attires like Alexan, and also education like Unita, Cosmopoint, KL Metropolitan, and University College, which have all suffered severe setbacks during the pandemic. And we have had to be agile, quick and insightful to build resilience and expand value creation plans for the sustainability of these companies. To discuss further about private equity situation in Malaysia, we have with us in studio right now is Syed Yasir Arafat Syed Abdul Kadir, Chief Executive Officer of Ekuinas. Good morning, Encik Yasir. How are you? Thank you for joining us in Niaga AWANI. And we're going to start with our first question. Can you share more about the outlook of a private equity industry in Malaysia for this year?
Yeah, I think initially coming into 2022, there were a lot of optimism coming to 2022 on the back of very buoyant global stock market, ease of traveling restriction, as well as ability to meet face-to-face interaction, which all sounds like a good formula for deal making, essentially. But coming 9 months into 2022, the world is a very different place from what was initially anticipated. We have the Ukrainian war, clearly this tech stock crash. We have the fear of recession, inflationary pressures for a lot of the economy, hike in interest rate. So on the back of all of this, I mean, clearly the world that was anticipated coming to 2022 looks like a very different animal now, right? So what we're seeing is that although we're seeing quite a number of deals in the pipeline, there were a lot of issues as well before we could evaluate or decide before we do any form of investment. I think one is the valuation expectation has not come down in line with what's happening around the globe. I think that itself is an issue, especially for digital or technology companies. Secondly, what we're also seeing is essentially for a lot of the sectors, which especially those that benefited from the pandemic, some segment within the healthcare, some segment within retails like groceries and all that, have started to see their numbers to decline because they essentially benefited from the lockdown. So in relation to that, clearly a lot of investors are taking wait and see approach when the earnings normalize back to a level where people start to see normalized earning, which reflects the true sustainability of the business.
So will it be a year of divestment or investment or a mix of both? What is Ekuinas' strategy actually? So what is the area that you're looking on when talking about investment? So what are you looking to expect?
Yeah, I think from our perspective, it is a combination of both. We are looking to deploy our capital. We have not been deploying aggressively for the past 2 years, and thank God for that, because if you deploy for the past 1-2 years, especially if you deploy in a segment which benefited from the pandemic, I think you'll suffer a great deal of loss, right? So from our perspective, I think the wait and see approach, I think has worked nicely for us. I think we started seeing a more normalized revenue or earning growth for a lot of the companies. So I think from our perspective, we want to deploy, and we want to deploy quickly on the back of the current situation. At the same time, we are also looking to exit some of our portfolio companies, and I think certain segment has started to see. I mean, the irony is the company that did well during the pandemic has started to see a decline in earnings because they benefited clearly from restriction in operations. But the company that did poorly due to restrictions have now started seeing extremely high growth from their revenue and growth, especially in the retail sector. For example, as you mentioned, we own Alisan. Alisan has grown quite tremendously from where they were. In fact, even compared to 2019, they've grown quite significantly. We are seeing about 30% same-store sales growth, for example. So those are potentially the kind of investment that we look to exit within...
big potential of growth.
Yeah, yes, to exit within 6 to 12 months because we have clearly a track record to show post-pandemic that the business is stronger than ever. Because we spent a lot of time clearly during the pandemics to to do what's necessary to ensure that the operations are run more efficiently, to consolidate certain parts of operation, so that it'll be in a better place. And we invested quite a fair bit during the pandemic as well, in anticipation of opening up the economy. In fact, for example, for Alaisan again, we are opening up close to 40 stores this year.
Wow, congratulations.
Wow.
Yeah.
That's a lot.
Yeah.
Okay, clearly, like you mentioned just now, the industry is affected by the pandemic. So maybe you can share with us what were the challenges that they faced, the private equity players faced during that pandemic.
Yeah, I think for companies that's owned by private equity, they tend to fare better because private equity tend to spend a lot of times in terms of helping the company that they own during the pandemic, whether it's liquidity management, cash flow management, cost-cutting exercise, cost containment, trying to pivot more towards digital to increase different revenue channel or distribution channel. So I think from our perspective, the challenges was inability to operate for some of our portfolio company. For example, retail, unless you're essential services, you cannot operate during those periods. So that necessitates for us to invest in digital, to go aggressively into digital, to
build a better ecosystem for you to operate.
build better ecosystem to operate. But that again, either whether we like it or not, for like certain businesses, bulk of the revenue streams come from physical stores, right? For retail, for example, and e-commerce accounts for very little revenue. I mean, generally about 5 to 10% for most company, right? So it doesn't really compensate. But we have started seeing the growth post-pandemic itself, and certain like manufacturing, for example, because of COVID testing and all kind of restriction. If somebody has COVID, for example, the whole factory got to be closed, and those are the kind of challenges that we face during the crisis. But our portfolio tends to fare better. Unfortunately, the smaller companies that do not have the backing of private equity, for example, tends to suffer a bit more because of inability to operate.
So being faced with pandemic and new normals, a change in approach, so definitely has a change in approach. So what are the opportunities aroused during this situation, and can you share any key learnings from this?
Yeah, I think the key learning is really to be resilient during this crisis. There were different school of thoughts clearly during the pandemic. Some people think that it will prolong for the longest time. Some people think it will just be a temporary situation. I mean, clearly, those that thinks that it'll be persistent for a longer period of time, like the gloves company and all that, have clearly suffered, right?
Yes.
But those who thinks that it's a temporary situation, because avenue for you to increase sales are limited. One way to look at it, I think the key learning is really tightening up your overall internal operations. Looking at the efficiency of your organization structure, for example, is extremely key. To be focused on what you do. Focus a bit more on digitalization, because that will help eventually when the economy opens. Those are some of the key things that I think we have done during the crisis itself.
So in relation to investing in a company, right, what turns into a good company with a good potential into a success story?
Yeah, I think there are many factors to that. I think the big part of it is really the founder and the management itself. I mean, for any company to grow, the limit or the constraint is always ability of management to grow the company. And with that comes with strategic focus, which is also extremely key. Some people tend to do a lot of other things instead of focusing what they're good at. I think strategic focus is extremely important for a lot of companies. Operational excellence, again, it's another factor. You can't grow to a level that you want if you don't have operational excellence. And I think that's a very important factor. Financial and governance is also, governance is also a key thing for a lot of companies, because you're only as good as people trust the numbers that you're producing. If people don't trust numbers, or if you don't have a proper check and balance system within your organization, I think it's going to be very, very difficult to operate or to gain the trust of the public on that.
I want to add a few more if I want to go specifically on F&B sector.
Sure.
So is it the safest investment towards F&B during the challenging time?
No, actually, on the contrary. I mean, it's not easy, because I think for F&B, like you know, I mean, it's not viewed as essential, or even is essential. If you're located at the mall, there's no traffic. People can't go to the mall to eat, right? So your only other revenue besides physical stores is essentially through basically e-commerce, like clearly like Grab or all the other food delivery apps, essentially, right? So that accounts for fairly little in terms of compared to the footfalls that we have at the malls, for example. So I think for our F&B, I think we suffer. I mean, clearly during the pandemics due to restriction, but I think post-pandemic we have seen quite significant increase in footfalls in our stores as well, and clearly I think they tend to do better because with clearly with delivery apps and all that, clearly on top of that you have to pay commission to the delivery partners and so forth, right?
Right. So far, what is your hope for in the private equity sector in terms of the balance of this year?
No, I think we remain cautiously optimistic. I'm hoping for, I think, valuation to come down to reflect the real situation on the ground, especially for technology company. I mean, while the global valuation has adjusted, I don't quite see valuation locally has adjusted and in line with the global valuation. I'm hoping to see that. I'm hoping to see clearly growth for some of these companies. I mean, for example, retail sector, if you look at the government report, I think first half of the year has grown significantly. We're looking at about 20 to 30% growth in retail sector in general, which is a good thing. In the second half, not sure whether that can be repeated again, because there are a few factors influencing in terms of first half growth. One is countries just out of pandemic. People just can't wait to go out, right? So there's element of revenge spending. There's also element of withdrawal of EPF to a certain extent, impacted in terms of people appetite to spend, and a few other factors. I think going forward into the second half, I think yet to be seen whether the mood will continue to be positive. I hope it will be positive. Because I think the challenges is a fear of global recession, how long will the Russian-Ukraine war last, as well as essentially the key thing is whether there will be another 1 or 2 rounds of interest rate hikes.